James Walker-Powell. It's Fund Manager Friday, and we've got Anthony here today. Anthony's going to be talking about something different. We're not going to be talking about a particular fund, we're going to be talking about the economy. And Anthony's actually the high priest of all funds management because he's the economist. And the economist is pretty much the high priest of every funds management. He's just moved to Pinnacle, and it'd be really good to actually pick Anthony's brains and talk about what we can expect in the investment markets, particularly this year, a bit of the Trump effect, and really sort of like peel up the onion, look under the Komodo and see what's really going to happen. Good to have you here, Anthony.
Cheers, thanks very much.
Good on you, mate. Yeah. So tell us a bit about yourself, mate.
So I've spent 22 years in investment markets across a lot of different asset classes. So stocks, bonds, started as an economist, as you mentioned, at Macquarie Bank just over the road here in Sydney. And so...
is that a fair enough analogy to say that the economist is the high priest of any funds management?
I think it's an interesting analogy because a lot of finance, and you're making predictions, you're making forecasts, it's believe me.
Yeah, sure.
Do you believe me? Do you believe what I've said? I've done the work, but ultimately the future is unknowable. So that's why often economists are surprised when events occur that are low probability events, but they're so important to your long-term returns. So I think it's a pretty fair analogy, yeah.
Yeah. Well, I mean, I guess basically as a financial planner, we are very much a poor man's economist because when we talk to clients, they think we're up where you are, you know.
Yeah.
But we've got a really good basic knowledge of all financial planning matters. We're no high priest, but most financial planners are really good generals. You know? So fantastic. So let's, where are we as far as the economy is concerned? What do you reckon?
Well, this year's been dominated by one guy in the White House, right? DJT, Donald Trump, and he's caused a lot of upheaval and a lot of what we describe as volatility.
Yeah.
Volatility is when the value of your stocks are moving up and down very, very quickly. And so Donald has some interesting ideas of how economics works, and he's implementing those ideas as the President of the United States. And so it has large ramifications for stock markets in particular, but also bond markets, because of the uncertainty that's following from many of these policies.
I'd be really interested to know your take on what Donald's supposed to be doing.
Well, it's easy. It's the art of the deal. So Donald
art of
Trump,
the deal.
It's the art of the deal. He's got a book about it. So
Okay.
if Donald Trump wants to sell you a house and he wants $2.5 million, he's going to say, I want $3 million.
Right, yeah.
You offer 2.5, and Donald says, done. You're happy you've got $500,000 off what you thought was the listing price, and he's got what he wanted all along.
Yeah.
So tariffs are the center of his economic policy.
Yeah. What's the go with tariffs? Why tariffs?
Well, there's a couple of reasons he's doing it. We know what he wants to do, make America great again.
Yeah.
And
Good on him.
American industry has been decimated because you can produce things in other emerging market nations like China much cheaper because the wage costs are much lower.
Yep.
So this is why he's implementing tariffs on China in particular, higher tariffs than other places in the world such as Australia. But he thinks that if you have a current account deficit, which means you're importing more than you're exporting to a country, then that's making America weaker. So he wants to bring industrial manufacturing, like making cars, back to the United States.
Do you reckon it'll be successful? I mean, I like that strategy. I think it makes sense to me. But do you reckon it'll be successful?
I think it will be successful in attracting investment within the United States, definitely. And we've seen companies around the world saying we're going to bring some manufacturing to the United States. But ultimately, the question is whether Americans want the types of jobs that are being produced.
Yeah, I saw that
on the assembly line.
Did you see that? The fat people with the McDonald's wrappers, something on the sewing machine.
I mean, more interesting is, and it's hitting the headlines now, so it passed Senate overnight, the big, beautiful bill, which is a huge fiscal stimulus package, involves corporate and income tax cuts, huge amount of spending from the US government. It's still being negotiated through, but Donald Trump is saying, look, if we put tariffs on these countries like Australia, 10%, it will help pay for the stimulus that is coming via his big, beautiful bill.
Well, I guess it's a bit like our GST, isn't it?
Yeah, well, and you see how the GST is carved up amongst the states as well. So, I mean, this uncertainty that is permeating through markets, it's very, very easy for investors to get caught up in the noise of those gyrations.
Right,
and what your clients should remember is that the media exists to sell advertising.
Absolutely.
That's their business model.
Yeah. I'd rather actually talk to you than Carl Stefanovic.
Well, Carl as well, you know, he says controversial things so that people watch, and that's why people watch.
Yeah.
And that attracts more advertising dollars.
Yeah.
But ultimately,
he's a pain in the ass.
over the long run, what you find is that...
Sorry for all those Carl Stefanovic fans.
What is the main importance is a company's earnings, and you can talk about a small business, a cafe on the side of the street, or you can talk about these large mega cap style companies like Meta or Alphabet or Apple or CBA. What ultimately matters is what level of earnings they're generating.
All right, so most people are basically really interested in how their superannuation balance is going to go up, is it going to go down? How can you see the two main assets, shares and fixed interest, going over the next year or two? What do you reckon?
So I'm pretty optimistic on equities in particular. And there's
Australian equities and US equities?
Yeah, and there's reasons for that. Really, why I'm confident is inflation is falling and is comfortable for central banks. And when I say inflation, that's not cost of living. What they look at is a basket of goods and services. But for me, when I had young kids, you know, my kids are 7 and 9 now, but when they were 3 years old, obviously I was spending a lot on nappies.
Yeah.
So that came into my cost of living. But it's a very, very small portion of the CPI, the Consumer Prices Index. Now, housing is around 20% of that index, but how often do you build a new home? Not too often.
Thank
Maybe
God.
once or twice.
Yeah, thank God.
So when I say that inflation, it's the RBA's measure, the Reserve Bank of Australia's measure of inflation, or the US level of inflation. It is falling. Why that's important is we're seeing rate cuts. So we're going to see a rate cut from the RBA next week. In all probability,
Yep.
there's 93% probability priced into the bond market of that happening.
I'll back those odds.
And the bond market is pricing in a cash rate of 3% in Australia.
Right.
Now, lower interest rates typically support higher equity markets and higher valuations. So even though we've had a big bounce off the lows of April in peak tariff uncertainty time, I do expect that equity markets will perform well.
So equities, both Australia,
Aussie and US,
and I guess the issue is that when bond markets fall, you actually get an increase in your bond price. That's how it works, isn't it?
Duration, what they call duration.
Duration, there you go.
Yep.
So what can we expect in the bond markets?
I think what's appropriate at this time, when you have a level of interest rates of shorter duration, so like the cash rate, for example, or a bond that is matures in 1 year time or 2 year time, it's appropriate to look for strategies, fixed income funds, that are aiming to produce, say, the RBA cash rate plus 2, 3, 4%. So on that side of things, in terms of fixed income, you can look at what are described as floating rate notes that generate a higher yield, which can be attractive. On the other side,
Let's look at a 10-year bond. Okay? The 10-year bond. Ours has been stubbornly, basically, a 4, 4.5, 4, 4.5. Is that going to go down? If that goes down, how far? And what do you reckon, basically, if it goes down, what type of capital value will clients get because the interest rate has gone down the bond? What do you reckon?
so the duration of a 10-year bond is around 8 years.
Yep.
So
That's the
interest
average,
rates fall by 1%, you'll make an 8% capital return plus the yield, which is around 4.5.
Say that again. I knew it. I think it's worth actually saying again. So an interest rate, one interest rate.
1%, if it fell by 1%, you would make an 8% capital return.
Capital gain.
Yes, plus the yield on the bond.
Unbelievable. So it's if we see that 10-year bond come down, let's say to 3, a client with a 10-year bond will make an 8% automatic capital gain.
Yeah, it would gradually get there.
Okay. Plus 4%
Yes, the
Oh,
yield
three-
for
yeah,
the running
yeah.
yield. Yeah.
Probably. There
It's
you
a
go.
good. It's an asset that you own as a diversifier
Yeah.
for your growth assets. It's
Yeah,
what's
sure.
described as a defensive asset, but it can go the other way as well, right?
Yeah, absolutely. We experienced that, just after COVID.
Yeah, well, I was going to say one area I think that is really interesting is
Yeah.
private credit as
Private
well,
credit, yeah.
which is non-bank lending. So Aussies are very familiar with the big banks making loans to small and medium-sized businesses or real estate projects. I think private credit can stand up as an area where you can generate high income, 10, 11, 12%.
So your suite of fund managers that you deal with at Pinnacle, one of them is Metrics, is it?
Correct.
Yeah.
Yep.
So they're private credit.
Private credit, yeah, exactly. So typically a very attractive income. And what's interesting there is that in a lower interest rate world, typically you find that economic growth outcomes are stronger because interest rates are falling. And as a result, default rates are lower as well. So if you think about a bank lending to a customer for a mortgage, obviously as interest rates are falling, that mortgage is easier to service.
Thank God
It's
for
the
that.
same. It's the same in private credit.
Yeah. All right. Well, I reckon we pretty much covered it. You got anything else, mate?
The main thing is to really cut through the noise,
Yeah.
and really benefit from the long-term tailwinds. I often see investors caught up in short-term volatility,
Yeah.
and what you often hear is that, and I'm sure many advisors have these conversations with their clients,
So
take a long-term
Yeah.
perspective, but when the market
cut through the noise.
sells off,
Yeah.
suddenly their long-term perspective becomes
Yeah.
very, very short. So the great thing about growth assets like equity markets or assets like fixed income, private credit, is typically, and particularly for the equity market, the longer you invest for, the higher likelihood that you have a great experience.
Yeah.
And it's the engine of your wealth accumulation that will really help you meet your long-term investment goals.
So as a financial planner, I say to clients, and they're probably over, but it's a long-term game. We get a strategy to start off with, and stick that strategy, and don't deviate. And I think basically, if clients do that, they'll be in good stead. According to the high priest. There you go.
Cheers. Thanks for having me.
Cheers.